Hey everyone, and welcome to this explainer. Today, we're diving straight into the true art of market charting. We are going to completely reframe how you look at technical analysis. Forget just tracking price. We're talking about reading a highly logical, visual map of human emotion, supply, and demand.
So here's our roadmap for today. 1. Decoding the market's language. 2. Mapping market structure. 3. Visualizing crowd behavior. 4. Volume and key indicators. And 5. Mastering risk and psychology. Let's get right into it.
Now we've got to address the elephant in the room right off the bat. Are these charts just random noise? I mean, to a casual observer, yeah, it kind of looks like chaotic, squiggly lines, but professionals see it completely differently. To them, technical analysis is the study of historical footprints. It gives us a real, probabilistic edge on what's likely going to happen next. It's definitely not magic, right? It's simply understanding the past to gauge the highest probability for the future.
Which brings us to a really crucial point. True technical mastery starts with a clean chart. You've literally got to toss out the myth the financial markets move purely on news. Sure, news is the fuel, but price action? That dictates the timing and the actual direction. Think about it. At its core, price is just an agreement between buyers and sellers at a single point in time. It's a real-time recording of a constant tug of war. Price itself is the ultimate leading indicator. Everything else is just a derivative.
Okay, moving into Section 1, Decoding the Market's Language.
So, candlesticks. They are the absolute go-to for visual price representation because, well, they're incredibly efficient. Every single candlestick packs 4 critical pieces of info into one neat visual block. You've got the open, the high, the low, and the close over a specific time frame. Grasping this anatomy lets you read price action bar by bar. You just have to ask yourself who controlled the open, who pushed the price to those extreme highs or lows, and ultimately, who won the close.
And look at the contrast here. The real body of the candle shows you who actually won the battle during that session. A large, solid green body? That means dominant buying control, no question. But the wicks, or the shadows, those tell the real story of market rejection. Imagine seeing a massive lower wick. That tells you sellers desperately tried to push the price down, but buyers stepped in aggressively, absorbed all that pressure, and drove the price right back up. It is a beautiful, visual story of rejection.
All right, Section 2, Mapping Market Structure.
Listen, before you even think about entering a trade, you have to know your market structure. The market basically moves in 3 distinct phases. First, uptrends. That's a series of higher highs and higher lows. Then, downtrends, lower highs and lower lows. And finally, consolidation ranges, where the market finds equilibrium and price just bounces between the top and bottom. Understanding this is absolutely vital. I mean, trying to buy during a strong downtrend without waiting for a structural change, that's literally like standing in front of a freight train. Just don't do it.
Now, built into these structures are support and resistance, the invisible walls of the market. A lot of beginners treat these like exact, razor-thin price lines, but the pros, they know these are actually dynamic zones of supply and demand. Support is a floor where buying demand finally overcomes selling pressure, and resistance is the ceiling overhead. And they work simply because market participants have memories. If the price bounced hard off a level 3 weeks ago, you better believe traders are watching for repeat performance when it gets back there.
And this leads to one of the coolest phenomena you'll see on a chart, the principle of polarity, or role reversal. When a major resistance ceiling gets decisively smashed through, it flips. It becomes a brand new support floor. Why does that happen? Trapped positions. The traders who shorted at resistance are now getting squeezed out. So when the price comes back down to test that broken level, those short sellers are desperate to exit at break even, while sideline buyers are jumping in. Boom! The price pushes higher.
Next up, Section 3, Visualizing Crowd Behavior.
Because human emotion really hasn't changed much throughout history, specific visual shapes, chart patterns, repeat with incredible reliability across all time frames. You've got continuation patterns, like bull flags, which basically tell you the trend is just taking a breather, pausing to build energy before it takes off again. Then there are reversal patterns. Think of the classic head and shoulders, signaling buyers are losing their momentum and a top is forming. Or the double bottom, forming that massive W shape. That W is practically screaming that sellers have totally exhausted their inventory and a reversal is imminent.
Which brings us to Section 4, Volume and Key Indicators.
So while price tells you what the market is doing, volume tells you the actual conviction behind that move. Trading price action without analyzing volume is literally like driving a car without checking the fuel gauge. Let's say you see a breakout above a massive resistance level, but it happens on super low, declining volume. That is a giant flashing warning sign of a false breakout. It means there's no heavy institutional participation, and it's probably just a trap for unsuspecting retail traders.
Volume always has to validate the price action.
Now, we all know those amateur traders who completely clutter their screens with endless math indicators until you can't even see the candles anymore. Don't be that guy. True mastery means treating indicators as secondary tools for context, not your primary triggers. A 50 or 200-day moving average? Awesome for revealing macro trends. Momentum indicators, like the RSI, super powerful, especially for spotting divergences. Like, if the price makes a lower low, but your RSI makes a higher low, that's a bullish divergence. It's this subtle little footprint proving that the selling velocity is rapidly slowing down, which often presages a major trend shift.
And let's talk about how this all builds into your execution. A huge, devastating trap is looking at a single time frame in a vacuum. A 5-minute chart might look incredibly bullish, right? But meanwhile, it's secretly crashing right into a multi-year resistance ceiling on the daily chart. You always have to use multi-time frame analysis. Start top-down on the weekly or daily to find that macro trend, and then zoom into the 15-minute or 5-minute for your precise entries. Doing this guarantees you're trading with the wind of institutional money right at your back.
Finally, Section 5, Mastering Risk and Psychology.
Here's the hard truth. You can have absolutely perfect chart reading skills, but without strict risk management, one single bad trade can wipe out months of hard work. Professional traders live by a golden rule. They never, ever risk more than 1 to 2% of their total trading capital on any single trade, period. And they enforce this by always using a predetermined stop loss. It's not just some random dollar amount you pick out of thin air either. It's placed strategically at the exact technical location where their chart hypothesis is proven wrong.
Equally important is the risk-to-reward ratio. Before even thinking about pulling the trigger on a trade, successful traders make sure their potential upside is double their downside risk. That's a 1-to-2 ratio. And why is this so powerful? Well, with a positive 1-to-2 ratio, you can actually be wrong more often than you're right. Seriously, you could win just 40% of your trades and still be highly profitable over a long series of executions. It's just math.
But actually enforcing those mathematical rules, that requires mastering your own mind. When real money is on the line, greed and fear are going to try to hijack your discipline. Greed leads to over-leveraging and chasing the price, or taking profits way too early. Fear makes you freeze up. But you know what the most catastrophic psychological mistake is? Moving your stop loss further down when a trade goes against you, just because you can't swallow a small loss. That right there is exactly how a tiny, manageable paper cut turns into a devastating account blow-up.
So to completely eliminate those emotional traps, every single trader needs a written trading plan. Think of it as your personal operational blueprint. It has to clearly define your market selection, your exact technical setup criteria, your strict risk parameters, and your post-trade review process. Honestly, logging every trade with screenshots of the chart before and after you execute is the absolute fastest way to level up. It transforms your trading from a stressful, emotional guessing game into a systematic, probabilistic business.
Technical analysis really is this incredible blend of science and art. But remember, there is no holy grail indicator out there that guarantees a win every single time. As we wrap up this explainer, I want to leave you with a really crucial question to ask yourself the next time you sit down in front of those charts. If you haven't mastered clean price action, enforced disciplined risk management, and achieved complete emotional control, are you really trading the market, or are you just battling your own emotions? Master the chart, master yourself, and transform this whole thing from a confusing puzzle into a lifelong skill. Thanks for joining me.